invested in the internet bubble at that time, so there hadn't been a lot of construction. And so it was a good time to invest in real estate, but I didn't know that at the time. What I knew was I didn't understand the internet and why people needed more routers and why pets.com should be a good investment or not. But what I did understand was everyone needs a roof over their head. It's a necessity purchase. And so that was why I got in the business.
Welcome to Real Estate Hustlers Podcast. I'm your host, Josh Appelman. Today we're joined with Dwight. Dwight shares 25 plus years of multifamily investing wisdom, covering vertical integration, disciplined leverage, community-driven alpha, smart 721 exits, and strategic positioning for 2026 opportunities. Dwight, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Yeah, well, great to be here, Josh, with you, and excited to talk to your listeners. I started Bonaventure 25 years ago, fell into an opportunity to buy an apartment building, and spent the last 25 years building a platform to help our family, our partners, and investors co-invest with us to build long-term wealth through investing in apartment buildings. Today, we manage just under $3 billion worth of assets across about 5 different aligned businesses. I live in Alexandria, Virginia. I've got 4 kids and a wonderful wife and a dog named Lando.
Good deal.
Named for the current Formula One world champion, Lando Norris.
Nice. Good deal. Nice little touch there. So let's go all the way back to the beginnings. Let's go with your first real estate transaction, what that looked like, and so on and so forth.
I'd say if I had to sum it up in a word, it looked kind of crazy, because if you wind back the clock 25 years ago, I was 25 years old. I was attempting to buy a 378 unit apartment complex from a huge real estate conglomerate. Took about 9 months. There was 1,000 things that could have gone wrong, any one of which would have blown up the deal, but somehow through perseverance, tenacity, and a bunch of luck, none of that happened. I thought that it was just going to be a one-time transaction, and I'd buy a cash flow here, leverage it lower, earn a spread. But turned out that I really loved real estate investing, and we started building a company around some simple premises of long-term, tax-efficient compounding, using fixed-rate debt to avoid the risks that come when liquidity cycles cycle, and really building a franchise around tax-efficient compounding.
So I was expecting to hear a single-family house as the first one. So
that's why it's insane.
378 units. Something prepared your brain to take on something that big. So tell us about before you got this opportunity. What prepared you for this?
I went to University of Virginia, got a fantastic education with a degree in finance, went to work for an investment bank and then a boutique kind of private equity firm, and got really a great education in life in a rapid period of time, and heard opportunity knocking, and I just grabbed the doorknob and pulled.
How did this opportunity come about? Was it just, that's a big part.
So our family had been an investor in this property, and it was controlled by a very large publicly traded real estate conglomerate. We had collected checks for decades and got to the point where this large real estate conglomerate had moved on to other things, and we felt like no one was shepherding our family's crown jewel. And so we went to a meeting, and they said it was a terrible property in a C location, needed $5 million of capital improvements, and you'd get zero return. That was just to keep the lights on. And so anybody that knows investing is, if your expected return is zero, don't make the investment. So that was issue 1. Issue 2 is we didn't have $5 million. And so right there on the spot, my dad said, "What do you think we should do?" And I go, "Well, this is a big problem. I think we should buy them out," which sounded insane, given I had no real estate background. I was 25 years old and certainly didn't have the $22 million of cash required to buy them out. My dad said an even more insane thing was he said, "Sure." And that was it. Like literally, that was the conversation. It wasn't well thought through. It was just, there's an opportunity here. It's out of both necessity, and we believe that they weren't watching the store. And it just worked out.
So that's cool. Your family was invested into the property already,
Yep.
and already had real estate in their portfolio. So you grew up knowing to invest in multifamily in a sense.
Yeah, I mean, we were not in the business. We were passive investors. We got checks every month, and every 10 years, there'd be a refinance of the property, and you'd put a big check in the bank. And so, like, I got the business at a very like abstract level, and I also was blissfully ignorant. I was like, how hard could it be? It's just renting apartments. It's obviously not a hard business in terms of you don't need to be a rocket science. What makes it hard is there's 1,000 things that you have to do every day. And if you don't do those, you end up with a really bad situation. And that's kind of the Medusa that most people stare at, and they kill themselves.
So and I like to double down on first acquisitions because they're always the hardest, and those learning lessons mean a lot to the listeners. So you all decided that you're going to attempt to buy out the partners, the big conglomerate, institutional fund, whatever it may be. Approach a bank. How did?
So I was like, well, I need like an $18 million loan. And so a friend of mine, I didn't know where to start. Like, I literally had no relationships. Our family didn't have any relationships. So I just started calling people I knew. Someone I went to college with was a branch manager at SunTrust, which is now Truist. They said, I can't help you, but let me find someone in our commercial real estate department. They introduced me to someone. Long story short is, through that networking and perseverance, I got in touch with Fannie Mae and somehow convinced them that it was an amazing credit decision for them to lend me $18 million at 25 years old. I thought it was a great idea for me to start a property management company with zero experience. Like, I literally have no clue how I was able to accomplish these things, because today I don't think it would go. And certainly when I tell this story today as a 51-year-old who's been doing this a long time, anyone that came to me with the business plan I had, I would have said, there's no way that's going to work. And so it was just, I got really lucky. I just kept pushing. There's a million obstacles and somehow got around them all.
Right? And that's where perseverance just outweighs everything else too. But and this conversation goes even deeper now. So now you're kicking up a property management company. So there was not third-party property management on site, or there was?
No, the conglomerate that owned it had their own property management company. And during my due diligence period, every time I'd go there between 12 and 1, the office door was locked and it said, we'll be back in an hour. Well, turned out after a few weeks, I finally figured out what was going on. The property manager would go across the street to the model and watch soap operas. And I'm like, well, it's not the person I want leading things. And I was like, you know what? How hard can this be? I'll just do it. So literally, I bought some cheap software called Tenant Pro, which was like the cheapest property management software I could find. And I just started leasing apartments and started hiring people. And then it's like, well, I hate this because I can't do it all. So I then moved my office to the apartment next door and brought in a property manager. And so I had my little management company. I was scanning checks. I was paying the mortgage. I was doing payroll. And that's just how it started.
Very cool. So did you bring on any partners on this acquisition, or is it just you brought in the capital?
No, we a lot of loan and leveraging the equity we had. Now, fast forward 18 months, the property's NOI grew and we refinanced out all of our capital. I, as a 26-year-old with a huge head at that moment, because I was like, I crushed it, said, I must be great at this. Let's do it again. In retrospect, I wasn't great. It was just that it was a rising tide. It was a 10% rent growth year one and a 9% rent growth year two. Like, anyone could have increased NOI. But we increased our NOI. We refinanced out our capital. We then went and bought the second acquisition, which was even bigger, 664 units in Richmond. And we started bringing on friends and family money.
I need to correct you, though, because you said anyone could have done it then. That is not the case. Because being an active operator, present on the property, in the weeds, that's exactly what makes the NOI go up. Now, the person that was watching soap operas, that property would have still just been churning the same exact situation it was in before you took over.
I remember at the time a 2-bedroom rented for $950, and I did my informal rent survey back then when were allowed to do rent surveys. I was like, we can get $10.50 for this. And the property manager I'd hired is like, well, we should only give $25 rent increases. I was like, why?
Mm-hmm.
And I was like, do $100 rent increase. And it was kind of the first real aha that like this business was run for convenience. It wasn't run as a business.
Yeah.
And in most other businesses, you price your product to meet where the market demand starts to fall off, not underprice it so that you stay full. And that was the mentality, was like, stay full. And that was just not the metric we wanted, which was maximize cash flow, maximize value over the long term.
Yeah, that's huge. And I mean, you doing exactly what you did, being in the business every single day. I mean, that's why it enabled you to go to the next level. Why, personal question though, why bring on family and friends and partners after you've already went through all of the hardest part there? Why not keep growing on your own?
Yeah, well, we brought in partners on for the next acquisition. So we brought in capital partners because the next acquisition was like 40 something million bucks.
Okay.
And it just required more capital than we had available. And so I unwittingly became an alternative investment manager without knowing that's what they were called back then. I was doing a deal and I hoped to make everybody money. And if I was successful and we exceeded that minimum return, we'd get a profit share or promote. That was the simple plan then. And that deal also turned out to be a grand slam home run as well. It was a good time to be investing in real estate in retrospect. Interest rates kept falling, cap rates kept falling. A lot of money was being invested in the internet bubble at that time, so there hadn't been a lot of construction. And so it was a good time to invest in real estate, but I didn't know that at the time. What I knew was I didn't understand the internet and why people needed more routers and why pets.com should be a good investment or not. But what I did understand was everyone needs a roof over their head. It's a necessity purchase. And so that was why I got in the business.
That's huge. What have been like your biggest learning lessons along the way? Because you've got a long track record.
Yeah, every Excel model is wrong is number one. Like I have never seen an Excel model that was a perfect prediction of the future. It's a tool to help you take something massive and think about it like a model airplane or a model boat. You know, if it's a model aircraft carrier, that thing is 1,000 feet long, and you can create one that's a replica of it that could sit on your desk. And so it gets the gist of it, but it loses a ton of details. But it gives you an overall framework that you can pick it up and hold it in your hands. Yeah. And I think that that's what really an Excel model is like the Excel model is a representation of a very complex business that is actually a physical asset. But I think a lot of people forget that, and they think the investment is the model. And they fall in love with their model and they say, this is absolutely going to happen. I've got it to the 4th decimal place, so clearly it's precise. And the reality is the model is not that. It's just simply a representation that makes it easy for you to understand a very complex dynamic situation called a piece of real estate.
Yeah. Either it works or it doesn't work, and here's why. And if you can't, there's not enough delta in between of a good story.
And then I think people lose the business plan because they obsess about the Excel model. It's like, you know, a bunch of analysts sit out the window from me right now, and we'll say, let's talk about this deal, and they'll pull up an Excel model. I'll be like, close that. I want you to tell me the business plan for this and why you think that it's a good investment and how it could be wrong. And if it is wrong, how do we protect our downside while being levered to some good things happening? We make even more. And that's, I think the thing I learned was like Excel is a tool, but it gets in the way of people just like being able to talk about why would you make this investment.
Yeah, we've been we've had rent comps look really good. We'll go in, we'll underwrite to the rent comps. Of course, that's what you do, in place versus market. You get in there, you start doing your renovations, you do your lifts, and you find out that you're not able to get the leads and the quality tenants that you need to get to those market rate rents. And then you get those on your second leases, but they have to deal with the first lease, needs to deal with all of the changes of the community, and then it lifts from there. But it just takes time, and I think that's one thing that doesn't get underwritten properly, is the amount of time to get to the market rate rents on a heavy lift too.
Absolutely. But in Excel, it made sense, right?
Yeah, Excel, 18 months, and we'll be there. And performa looks good. This and that. It doesn't. It just doesn't negate all of the in between things, the brain damaging things to get there to your market rate rents. What kind of assets are you all going after? Is it A? Is it B? C plus?
Great question, and the answer is it changes over time. Our kind of broad lens is housing policy is broken in the United States. Land use restrictions, building code requirements, the list of challenges goes on and on. And so the ability to bring housing online for the places that people want to live is hard. And so that's the pervasive kind of situation we find ourselves in. But as the economy cycles, there's different ways to make money with that backdrop. So sometimes it's build stuff. Sometimes it's by Class A that's levered to rent growth. Sometimes it's by value add. Sometimes it's by distress or recap somebody out who maybe overpaid or is over levered. And so it changes. So today, I think we're leaning more towards value add because market rent growth is very benign, and we want to own assets that we have really tangible ways to drive cash flow growth, as well as senior housing. That business has been 80 years in the making to get to today. And so if you just look at it statistically, our customers have been relentlessly marching towards needing that housing. And the growth in that population is explosive compared to the average market rate property. And so it has some really favorable tailwinds. Obviously, that could quickly change if everyone else starts building again. But right now, like, that's the best performing part of our portfolio.
I think senior housing, well, specifically like independent living type of asset, is the most resilient asset out there, I think, for now and for the foreseeable future. And I say that because I see AI on the horizon. I see a disruption on the A class, the core, because there's going to be a lot of, in my opinion, changes with job displacement. I don't see. There's either going to be a huge explosion of production, and that'll happen no matter what. But there's just tools that are coming out that can do things faster, better, quicker, cheaper than people that are currently sitting in those seats. I mean, like right now, this isn't the future.
I totally agree with you, Josh. Today at Bonaventure, we are rapidly moving all of our data sets to be accessible to AI tools. We are vibe coding the tools that we've needed for years, but currently have been done through dumping data into spreadsheets, sorting it for 5 hours, and coming up with an answer. We can now get that same answer in 5 minutes and better. When we want that same answer a week from now, we just hit the button and we get it in 5 seconds.
Yeah.
It's wild. And so I think the end result is I don't plan to be hiring headcount. What we plan to be doing is making all the people here more productive so that over time we can raise their compensation rather than just keep hiring more people.
Right. And now your bandwidth just 10, 20, 30x, if not more.
Yep.
And you're a smarter, more efficient operation and more resilient. But what does it do for all of the people that are dependent on the job, high paying jobs? I mean, we're 150, 200 plus that are those people that are, to me, that's the white collar, the A class tenant.
Yeah, no, I totally agree. I've got 2 kids in college right now, and I am telling them they have to become the best at using AI tools to have a chance of being hired, because jobs are in this interim period of time from now until whenever we learn how to have an economy that's powered by AI is going to be disrupted. And those entry-level jobs, the jobs that people have been making a ton at, all that is going to be thrown up in the air. And so when you look at what does that mean for rental demand, I think it's a big question mark to your question. And so we want to be positioned in assets that are less susceptible to that. Like it's really hard to outsource some of these more blue collar things. I think anybody whose job is connected via a computer screen and keyboard is primed for disruption.
Yeah. Yeah, and our portfolio is workforce housing, and we do a lot of our tenancies, Section 8 vouchers, et cetera, which that's where we're pushing towards more. 'Cause I feel like the future might have everyone in all walks, regardless of what your past career was. Maybe you have a housing voucher. Maybe it's just something that is an expectation, possibly. I don't know. I know that Congress is not moving fast enough to put things in place. I think a lot of these things should be shelved. I think that humanoids should be shelved for the military only, but that's coming in hot too. So, well, these are things to be concerned about, not only as an operator in housing, but as employees out there in the workforce. I mean, we're dropping our rent roll in and seeing who's working where and how. What does our rent roll look like? And yeah.
I mean, I think, Josh, what you are talking about is really what your audience should be talking about when they're looking at underwriting is every possibility is possible. And their job is to identify all future states and continuously adjust the probabilities and say, does my business plan survive some of those downside scenarios? So the one you just outlined is broad financial disruption, people with good paying jobs having no job or getting paid less. How does that affect my business plan? And let's say that's a 10% chance. There's another 10% chance that all of a sudden everybody makes more money because everybody is super productive and the economy explodes. And so like looking at all those scenarios and throwing it into your model of saying what happens, and if we have one of those downside chances and your rents drop by, your NOI drops by 10%, does your business plan survive? And if you can't say yes to some of those outcomes, then you need to readjust your business plan, because I think the most important thing to being a long-term investor is never getting wiped out. Preservation of capital. And so I think people have to be thinking about multiple futures at the same time when they think about what the world could hold in store, because no one has a crystal ball.
Yeah, that's buying at the right basis, making sure that you've got enough cash flow that it's kicking off for the rainy day scenario too.
Yeah.
So y'all are looking for value add opportunities in what areas of the country?
Yeah, great question. Our research has boiled it down to one thing: lack of supply growth. Like if you can analyze lots of data sets and so on, and certainly more jobs are better than less jobs, more companies moving are better than less companies moving, lower state income tax are better. But the number one determinant of rent growth is supply growth. And so if you can have less supply, you're going to have more rent growth. And so we're looking at those markets that have those positive characteristics of job growth, great regulatory environment, but also limited supply growth. Because the best markets for job growth have been some of the Texas markets, have been Nashville, have been Tampa, Charlotte. They have all been terrible apartment markets for the last several years, not because they didn't have wonderful business fundamentals. It's because they had an overwhelming amount of supply. So we're looking at those submarkets that have much more benign supply pipelines.
Got it. That's good. And that's the secret sauce then.
That's our secret sauce. I just gave away the secret. Coca-Cola won't do that, but Bonaventure just did.
Are you all looking at opportunities that might be coming up, surfacing for distress, or how?
Yeah, absolutely. I think to date I've seen no real major distress. There's been an oddball situation here or there. There's been quite a bit of discomfort, and so I think there's going to be a lot of capital that's going to totally miss out because they were holding out for that 25 IRR deal. There's just not very many of those. So we'd rather invest in those 18 IRR deals where, that'd be a great return. There's a lot more of those than holding out for the grand slam, home run. When I think about over my career, the ability to really seize those distressed deals has been few and far between. The ones that we've got our hands on, and I count them on one hand in 25 years, had been walk-off home runs, but I couldn't build a business over that.
But they were not walk-off home runs day one. It took a lot of effort, work, and perseverance to get them there.
And there were moments where like, this feels crazy. I remember buying a deal on the courthouse steps, like literally bidding against the bank. And the conditions of the bid were, in order to make a bid, it was just us and the bank, you had to give $1 million deposit. So I arrive 5 minutes to 9 in downtown Newport News. I'm talking to the trustee who's about to conduct the sale, and we're BSing, and he looks at his watch. He goes, "Oh, it's 9:00. Are you going to bid? Or are you just here for sport?" And I reach in my pocket and I pull out $1 million check and I hand it to him.
Nice.
And 5 minutes later, we had bid $32 million to buy a 308 unit apartment complex. And I did not know whether I did the most amazing thing ever or the dumbest thing ever, because you had to close in 30 days or you lost your $1 million. Turned out, in retrospect, it was by far one of the best investments we've ever made. But at that moment, if you're not scared to death, then you're in the wrong business. You're a gambler.
That's amazing. That's but then I'm sure that's a result of being close to the information too.
Absolutely. Now, what gave us the comfort was we'd been in the same submarket of that asset. We knew the scuttlebutt that there was some defect with the facade that needed to be remedied. We're like, even if it costs us $1 million, we're still so far below basis.
Stucco system?
It was not. They didn't put the right flashing around the windows on the vapor barrier, and so basically water got behind the siding and would just like go into the building rather than just continuing to go by down the vapor barrier. And so, but what really gave us comfort was our basis was like $110,000 a unit. Maybe we spend another $1 million. So let's say it's 115. We just built a building 2 miles away for 165.
So you knew the cost to build, right? This price per
and
square
so
foot.
We're like, the margin of safety is large, and it seems like it would be a really crazy set of circumstances where it wasn't large enough. We were getting it at truly 60% of what we just built a building. And so like that felt really comfortable that we could absorb a lot of unknowns and still be okay. The postscript to that story is, in a couple of years, in maybe 24 months, we refinanced all our capital out, and today that building's worth $80 million.
That's incredible. And
we just yesterday locked a loan to basically refurbish that property. We got a second mortgage from HUD at 5.2%, and we're going to, redo that property's interiors for the next 20 years.
So you all are very, very long-term holders.
Yeah, we're one of the largest borrowers from HUD, and it is certainly can be a journey for someone that hasn't done it. But if your goal is to build long-term wealth, there's no better financial partner than HUD.
What is the best loan that you've taken from HUD, the best type of loan?
We've done a lot of ground-up construction loans with HUD, where we've gotten maybe 80% of the construction costs, and that interest rate was fixed on day one for the next 42 years. We've also refinanced a lot of properties. In 2021, I think we have, several $100 million of loans that start with a 2 that my kids will hopefully pay off. And so it's not an easy journey, but it's the best outcome. And again, if you're really focused on long-term value creation, a extra 2 months of pain and suffering 30 years from now, you're not going to remember.
That's amazing. If somebody is now interested, they're watching the podcast, they're wanting to learn how to get into real estate, how to get their journey going, how would you recommend them get started?
I think the first thing is it starts with a mirror. And you look in the mirror and you take an assessment of your inventory of capabilities and skills, of things that you love doing and things you don't, and use that as the starting point to define how you want to access your real estate investment. So for instance, if you are not a handy person, you should not be doing a value add rehab yourself. If you are really good at marketing, maybe you can be your own property manager and find those tenants rather than paying somebody a 1 month commission if you're buying a single family home. And so really take that inventory of what you're great at, what your network is, what the things you don't like in doing, and position your real estate investing for that. I know a lot of people who think that real estate is passive. I can tell you it's not passive. Somebody has to do all those jobs. The only question is who is going to do it? Is it going to be you? If so, it's hands-on. If it's not going to be you, then you need to align yourself with a great set of partners and contract providers to do all the work. Because no roof fixes itself, no apartment leases itself, no toilet plunges itself. That has to be done by somebody. And so I think it's a really bad misnomer of real estate being passive. It can produce cash flow every month, but there's work to get that out every single month.
Awesome. Good advice. Like it. All right, Dwight, if somebody wants to learn more about yourself, your firm, possibly invest with you, if that's possible, how can they get a hold of you?
Yeah, super easy. Bonaventure.com is our website. There's a contact us tab. Put in a request. We will get it back to you immediately. I think, we help families and investors build long-term wealth. People can invest in our funds. People can invest in single assets. We have a huge franchise built around helping people manage their taxes through 1031 exchanges and 721 UPREITs. Uncle Sam is everyone's limited partner. We're experts in telling Uncle Sam to wait his turn.
Nice. Awesome. Dwight, definitely appreciate your time. I look forward to following you. Thank you.
Yeah, thanks, Josh.
All right. Bye.